Great. Yeah, so good afternoon, good morning, depending on what part of the world you're tuning in from. My name is Loyola Karuwa. I am an LLM student at the Center for Energy, Petroleum, Mineral Law and Policy at the University of Dundee. And I'm happy to introduce Mr. Stephen Dow. So we apologize, we've started a few minutes late, but we'll be able to make up for that time. Stephen Dow is a senior lecturer in energy law at the center. He's a qualified solicitor, and after a long period in private practice, he read a master's degree at this center, working on a post-privatization regulation of energy industries before he was appointed to the center in 1994. He's a co-director of the center's successful United Kingdom Oil and Gas Seminar, and his major interests are in energy projects, and he's also a co-director of the center's Energy Finance Seminar and the leader of the LLM programs at the center. So we'll kick right in, and thank you, Stephen, for joining us. I'll let you also further introduce himself.
I should start by saying thank you very much for the introduction. It's always embarrassing to hear people saying flattering things about you. We're here today to talk about project finance and energy. And please write in as you go so that we can focus questions, we can focus issues, so that we can actually focus on what you really want to talk about or what you really want me to talk about. Remember what project finance is. What project finance is the story of how small companies get to do much bigger things than you would expect those companies to do. It's enabling small companies to do, in some cases, very big things. Things they could not put on their balance sheet for themselves. What it means is that a small company with expertise, as a power generator, as a refiner, something along those lines, can leverage the bank's funds to do a very, very, very big project. What that then also means is that the bank is taking risk, and that's what differentiates project finance from standard corporate finance. In standard corporate finance, the bank is taking a credit risk on the company. In a project finance, the bank is taking a risk on the project itself. If the project is successful, the bank will be repaid. If the project is not successful, the bank will not be repaid. And remember that banks judge success by the bank being repaid, so there are undoubtedly projects out there which have made money to cover the bank's costs, cover the interest, and not made any money for the sponsor, but the bank would still regard that as a success. The essence of project finance means that because the bank is taking returns from the project itself rather than any other activities of the sponsor, what that means is that the bank is by definition exposed to a risk, and therefore the bank will mitigate that risk. The bank only ever deals with the borrower, so it falls to the sponsor to talk about all the other risks which are there in order to make sure that the risk profile of the project is acceptable to the lender. The lender doesn't negotiate with everyone, it's the sponsor who does that on behalf of the project company. So we have a basic structure out there. We've got a sponsor, an existing player, who will have a daughter company, the special purpose vehicle, which will become the borrower. The borrower will have will own the project itself. The borrower will take the loan. The borrower will eventually sign up to all the other contracts, but as they're negotiated before the borrower actually exists, the sponsor will do that in anticipation of the borrower being created. What we've really got is a system where the bank is involved as an equity player and doesn't really want to be that equity player. The bank is in the position that the owners are in. Remember, the owners only get paid if the project is successful. The bank is only getting paid if the project is successful. So in one sense, the banks and the owners are taking the same risks. But the bank doesn't want to be in that position. The bank doesn't want to be an equity player. The bank wants to be a bank. It wants to be a lender. And that's why it sets about making sure that the risks it's exposed to are as mitigated as they possibly can be. In an ideal world, the bank will have these mitigated risks down to zero, but achieving zero risk exposure for the project vehicle is, if it isn't actually impossible, it is next to impossible. Even if you could achieve it on the moment of completion, as we'll get to in a second, you won't be able to sustain that over time. There are currency risks, there are interest rate risks, there are performance risks which would stop that. So the bank can only ever mitigate. The bank will be taking a risk. It just makes sure through the process of mitigation of these risks through the other contracts which are surrounded in the matrix, the contract matrix surrounding the project, it just makes sure that those risks are mitigated to a level that the bank is happy with. What that really means then is project finance is a happy accident. If the bank likes the risk profile of the project, it will lend. If it doesn't like the risk profile of the project, it won't lend. And so therefore you can see where the space for competition between banks is. A sponsor says, I've got this wonderful project here, and takes it out in a beauty parade before the banks. And partly the banks are bidding an interest rate, but they're also bidding a risk profile. And I think it's tremendously important that you think of project finance across the whole of the project and across the whole of the time of the loan and then the project itself. That mitigation can take lots of forms, because remember, any risk that remains with the project is one that is by definition shared with the bank. So if the project is exposed to a performance risk, the bank is exposed to a performance risk. If the project is exposed to a price risk, then the bank is exposed to a price risk. And remember that these kind of risks are inherent in projects. Volume risks. The classic volume risk is usually expressed for example, an LNG liquefaction project. What you do in an LNG liquefaction project is you buy gas, you turn it into liquid, and you sell liquid to people with tankers. So in essence, you need the right amount of gas to be processed at the right time to go for the right amount of liquid. And so if you don't have enough gas, the buyers say, we want this much liquid, X. If you don't have enough gas to create that, then there's a volume risk. If you have too much gas, quite easy, it's still a volume risk, but it's easy to deal with because you simply push that next tranche of liquid into the next sales contract. So what we've seen automatically is that you can separate the downside volume risk from the upside volume risk. And that's how project finance works. Project finance isn't so much about the numbers, it's about an understanding of risks. And then you simply apply the numbers of that particular project to those particular risks. And it really is that mechanical, and it really is that straightforward, and it really is that time consuming. Because that means that any risk which is capable of changing the revenue generating profile of the project is one which you will have to analyse before you're happy that you've got control, that you understand what that risk profile then is. That also means it will change over time, because there will be risks which appear during the construction of the project which do not appear during the performance of the project. The biggest nasty risk for the bank in project finance is always getting to the point where the project will earn revenue. Completion, the construction risk if you like. And what the bank has to do is make sure that it is protected from the construction risks, because otherwise it really is behaving like an owner. Owners will take construction risks because that's what they do. The bank says, we're a bank, we want to lend to a project. What we want to do is give some money and earn money back on the interest profile and repayment profile, which we've already set. That's all they care about. End of. Banks don't get upsides, banks don't want downsides. So the bank says, I can't take the construction risk. I need someone else, the sponsor, to take that risk for me. And so you then see the classic structure starting to get a little bit more complicated. The bank puts up the money for construction, but the sponsor is taking the construction risk because the bank says, if we don't get to the point of completion, you, sponsor, will repay the loan. Now, at its bluntest, that's a simple concept. But remember, this might be tens of millions, hundreds of millions of dollars, and the sponsor might be quite a small player. How do you take a risk like that if you're a relatively small player? And that's when things get really complicated about making sure that there is bonding, making sure that there is potentially construction insurance, spreading the risks into the builders, etc. And you can see that the very simple concepts, the very simple ideas behind project finance are starting to lead into this much bigger field. And the bigger field is every step of it needs to be analysed. So in the construction risk, basically the idea is someone has to cover, for the bank, someone has to cover the space between starting and getting to the point where the project starts earning revenue, and starts earning revenue reliably. So it's not just, it's finished because the coat of paint has dried. It's finished because it's now able to generate power at a sufficient, for a sufficient consecutive number of days, at a sufficient heat rate or whatever it might be. It's finished because you are producing a certain number of barrels per day for 90 consecutive days, for whatever the completion test says. So you can see in project finance, the relatively easy idea, the sponsor takes the completion risk, becomes much more complicated when you actually try and write the agreements to do this. Because you're then saying, well, what exactly are we trying to do? Not just the completion risk, but how do we know that we've finished completion? How do we know that we've got 90 days is good enough, or 7 days production is good enough, or whatever? So we've got the technical requirements to take into account there as well. And so you see that in the project financing unit, within a bank, within a big company, whatever, there will be specialists of all descriptions. There'll be people who understand the numbers. There'll be people who understand the technology. There'll be the lawyers who get to draft up all these wonderful things, remembering that law is a reactive thing rather than a proactive thing. And you'll see that this all comes together to make sure that the project stands alone. It's got its isolated and assignable cash flow, and to all intents and purposes, the rest of the world doesn't matter. Project financing is all about trying to insulate that project from everything in the country, internationally, worldwide. It's all about making sure that the thing that matters is the performance of that project after it's complete. Once it's complete, the sponsor says, okay, now bank, I'm happy to, I've guaranteed you the construction has happened, my guarantee will fall away. And then at that point, the bank really is at risk. And it's at risk of the performance as mitigated by by whatever sales contracts, construction contracts. And that's the essence of it. That the bank says, get me to the point where what I am lending to is a project I understand. Get me to the point where the thing which you have built works the way you say it's going to work. And once I trust that it's going to do that, because I've seen this feasibility studies and I've agreed to all this, I will take that risk throughout the currency of the loan, throughout the duration of the loan. And that's the essence of it. Instead of the bank taking a corporate risk, the bank is taking a project risk. The bank is exposed to ownership, the same kind of risks as ownership, but it has mitigated them to the point where, well, it's happy. Now, some banks will be happy with more risk than other banks. Competition between banks will determine that. And you can see in history, the risks banks were prepared to take, pre-2008 are far more significant than risks banks will take today, simply because banks are actually taking risk, which they then have to reflect on their balance sheets. And if as a bank you want to look like a really good bank, you want strong things on your balance sheet, putting risky projects on it is not a good idea. Putting less risky projects is a wonderful idea. So you can see this is attractive to banks. It's also attractive to banks because, well, in taking that risk, you're entitled to be paid for it. You're entitled to charge a bigger interest rate on a project finance than you ever would on a corporate finance. You're entitled to say, I really am taking this risk. The only way I'm rewarded for this is through my interest rate. Because remember, the bank isn't rewarded by having a greater share of the project. The bank isn't rewarded by the value of the project rises and it can sell it. It doesn't own in that sense. It just is exposed to the same risks as ownership. So project finance is a wonderfully simple concept. The bank lends, the project gets built, and once the project is completed, the bank is exposed to performance risk until the loan is paid. It has all these complications to go with it. And we'll see questions, I hope, coming in on some of the fundamentals as well as the details. The great thing about this is because I'm facing forward, the questions appear behind me and someone will have to read them to me. But we'll get to that stage. Right. A couple of other points before we get there. Project finance in that sense, what we've talked about already, is really a loan. But you can achieve exactly the same result by other structures. Because remember, the goal here is to say, someone puts up the money for construction, someone else goes and builds it, you get to the point where it's finished, and then the person who put up the money is exposed to the risk of the project's performance affecting the cash flow to pay it back. Now you can structure that as a loan, you can structure it as a forward purchase, you can structure it as a production payment. Forward purchase is a sale. It can achieve exactly the same result as the loan, as in you put the money up front, you're the buyer of iron ore or whatever it might be. So you put up the money up front and you then just simply take delivery after the project is finished. So what you've done is you've bought the iron ore in the ground rather than put up a loan for construction of the project. The seller simply then uses the money for the iron ore to actually build the mine and then extract the ore and return it to the person who's already bought it. But you can structure it so that the risks are exactly the same. You can structure it to say, if the mine never gets finished, you will give me my advance payment back. In which case, that's the same thing as a completion guarantee. It just happens to be structured as a completion guarantee on a purchase rather than a completion guarantee on a loan. Same with a production payment, a very American idea, where what you're really doing is selling oil in the ground, or title to oil in the ground. It's a bit harder in the rest of the world where the landowner doesn't own the oil in the ground, than the offshore world where what you get is the right to explore and exploit. So what it's done is you take a right to the proceeds of sale. weird idea, but since the world's done it for 40 odd years, I don't see anybody successfully legally challenging it. And so it now is orthodoxy rather than something weird. But again, you can see the same idea. As long as you put the money up front, what you're doing is you're buying title to the oil on a defeasible basis. You buy the title, the other party then uses that funds to build the project, and then once you have been repaid from your share of the oil, you then simply transfer the title back. It's a defeasible transfer of title. It's a different structure to the same basic idea of project finance. That's what I meant at the outset when I said project finance is a tool. It's not a concept. It is, you can achieve the same outcomes by lots and lots of different ways. Before we open up, can I also say a few words about security? Do I have time to do that? Security in project finance is a very weird concept because in reality, what matters is the security of cash flow. The actual, standard mortgage style fixed security, floating security is a lot less important. Now, that doesn't mean you won't take it as a bank, because the great value of taking fixed security is no one else can have fixed security and no one else can have a better right. And you've also got a process under fixed security for calling up the project if you need to. So it's a convenience. But in essence, what really matters in project finance is security of cash flow. And so it's the security of knowing that the cash flow will be generated, i.e. you have measured the performance risks, you've measured the construction risks and said, that's okay, I can live with that. You've got enough security from the construction contractor that the construction contractor's done a good job, effectively a bond, something like that from the construction contractor, which says, we don't expect you to take, to offer, to guarantee that the project will operate at 100%. I'm building a power station for you. I don't guarantee that the project will operate at 100% of capacity, but I will guarantee it operates at something less than 100%. And if it's a really bad job, sue me, and here's my funds put aside, my bonding put aside to pay for it. But if it's an okay job, face it, I'm a construction contractor. What I want to do is build something. It works fine. My reputation is enhanced. I move on to the next project and forget about that previous one. That's what I want. So as long as I'm not guaranteeing too much, i.e. everything, then I'm happy with that. But the security for the bank is that, the really bad job is underwritten. And you'll also see security in the application of the cash flow. So when the project cash flow is earned, it doesn't go, off to, it goes into a trust, probably even an offshore trust, where the order of disbursement from that trust, the trust will be operated by a big bank, the treasury function of a big bank. And the order of disbursement of that fund is completely controlled. Remember, the first thing you will always have to do is pay the OPEX, the operating expenditures, because you want the project to work tomorrow. If it's a production project of some description, oil, etc., we'll come back to that in a second, then you probably will pay tax second. But there's an order to control, and then tax, then interest. Although the bank would love interest to be paid before tax. It's a negotiation in those. But remember, security in project finance looks a little bit different. It doesn't mean you won't take the fixed and the floating security, but what really matters is security of access to cash flow. And what really then matters is knowing that you've already assessed the risks of damage to that cash flow, of limits to that cash flow. That then also means that the point of termination, the point where problems occur, has to be related to cash flow rather than performance of the project. So the project, that's what cover ratios do. So there'll be an interest rate cover ratio, and there'll be a life of loan cover ratio, and everything else you can think of. And the essence of these is, what you want to do as a bank is you want to anticipate problems coming. You don't want to get to the point where the project is earning not enough to pay interest before you call a breach, before you call a problem, before you call a default. You want to cause some form of default before the actual problem occurs. So what the cover ratio does is it says you have to earn 1.5 times your interest rate, your interest amount in the given period, or twice the amount. Or if it's a really risky project and the bank wants lots of coverage, more than that. If it's not such a risky project, earn 1.1 times. This is how you see the difference between a project built in North Korea versus a project built in Texas. North Korean projects riskier. The bank says, oh, we need more mitigation, need a bigger cover ratio. Texas projects, less risky, smaller cover ratio. But what the cover ratio does is it makes sure that there is always enough money to pay the bank, because but we've seen, there's not enough extra money and the bank is getting nervous. So the amount you earn over what you need to pay the bank, what you need to pay your operating expenditure, isn't enough, and the bank says, this project isn't performing as well as I really want it to. And you can see that within the simple structure of project finance, the bank could take that risk, or it can mitigate that risk by putting in a cover ratio. And it can mitigate the risk a lot, or it can mitigate the risk a little. So you can see the space for competition between banks. You can see the space for the sponsor turning around to negotiate. And that's the essence of what makes project finance fun. That's the essence of what makes project finance, an industry of itself. We've got project finance departments of big consultancies, of law firms, of companies, of banks. It's an industry. And it's not because it's based on some wonderful basic concept out there. It's because all these nice little simple concepts have got consequences. And the consequences open up into making choices about lots of mitigation, a little bit of mitigation. The great difficulty of project finance, you pick up a book on project finance and it'll start talking about all resources projects as if they're all equal. They're not really. I mean, in the oil world, remember, there are a lot of companies out there which are big enough, ugly enough and rich enough to put in some money. So their need for project finance is different from other companies' needs. Don't get me wrong, there are small players out there in the oil industry too, but typically small players, what they do when they find a big oil field is rather than develop it themselves, what they do is they farm it out, or they sell it, or they sell themselves. So the oil industry is full of different sizes of companies. Project finance for the big developing companies doesn't really fit what they want to do. If all the value of one of their oil fields is locked up and can't be used for anything else because it's in the security package for that project finance. So you've got this huge oil field, you're paying off the loan, so that effectively, there's very little debt left in the project, but you can't really use that asset for anything else because it's tied up into the project finance. So even though there's only 10% of the value is actually the debt anymore, you've lost that value for other things. Project finance also doesn't really suit what you need to do. A lot of oil companies won't need to project finance. They can raise money more cheaply on their balance sheets. So a related idea to project finance for the oil industry is much more towards reserve-based lending. And reserve-based lending, a lot of the project finance principles are going to be the same because you're going to look at the same things which affect revenue. But instead of having a single thing in the security package, what reserve-based lending does is bring lots of assets from the company into the security package so that now we can actually raise money to do exploration and appraisal on one field by putting a producing field, which is earning money, into the security package. So the security package is not a single thing anymore. The security package is a lot of things at different stages of development, and including some which are in development and earning money. And as far as the bank's concerned, a lot of things in earning money to make it less risky. And you can see the scope for making this more risky or less risky. If you've got a lot of exploration assets in there which aren't earning any money yet, this is how a company can now afford to develop, to explore them, to drill the expensive appraisal wells. Remember, you won't get a project finance to drill an appraisal well because there's no cash flow back from the appraisal. You don't get project finance to do exploration. You do get project finance for development, but you have to pay for the exploration and the appraisal first. Remember, there are some parts of the world where you can spend $100 million drilling a hole, which is a lot of money. Doesn't mean all holes cost $100 million, but some do. Now, if you're going to spend that kind of money up front, it would be nice to have some of the bank's money to do that, wouldn't it? And so if you can put them into reserve-based lending, you put your producing fields into the same security package, and you can raise money effectively against the producing fields to pay for that exploration and appraisal. Now, RBL is a lot more complicated than that in reality, but you see the same basic ideas coming in. That what you're needing to do is understand the risk profile. You're needing to see, and the risk profile is anything which affects the cash flow earning potential of the project. So if there is something which is, in the electricity world, a currency problem. You've got your cost, you've got your revenue in local currency, but all your costs are in dollars and Swiss francs for your loan, right? So if the local currency falls against the dollar, you have a problem. And we've all seen parts of the world where the local currency has devalued substantially. You don't have to go much further than Indonesia, 2000, etc., where the value of the currency falls by factors of thousands. And at that point, a clause which says you have the currency risk doesn't mean anything anymore. It has no practical effect because there aren't enough wheelbarrows out there to carry the cash in local currency to pay your debt repayments anymore. So oil is much simpler than that because you will sell in dollars. And so the security package can reflect that. But the essence of project finance, of reserve-based lending, is to make sure that you analyse risks, that you break the risks down into a small part of the risk as you can. You're not just looking for market risks. You want volume risk. You want price risk. You want short-term price risk. You want long-term price risk. You want to say, what matters here is the status of the market. Much more likely in the gas world than in oil. Oil markets are lots of things, but they're pretty easy to understand, pretty easy to regulate. Gas markets typically are much more complicated. They're much less liquid, they're much less predictable. You can have trading points for gas where there isn't actually any physical gas. You can have, and you can have other points where you can't predict the gas price. Gas markets are, the standard terms and conditions, the non-price standard terms and conditions aren't always as harmonised as they are in, the European single market, etc. But so if you've got a simple market to understand, it becomes easier to evaluate your price risk, your volume risk. You all know there will be a buyer out there somewhere. But there are other risks out there, force majeure, performance risks, technical risks, all of which need to be evaluated by the banks before the banks get happy. And remember, before we go to questions, the one big message. If the bank is happy with the risk profile, it will lend. If the bank is not happy with the risk profile, it won't lend. Okay? One very last point, because I suddenly forgot, because there's a word in front of me, it says syndicate. We talk about the bank as if it's a single entity. It isn't. There's a syndicate of banks out there. So that the banks say, instead of, one of the ways I'll mitigate the loan is, let's say this is $500 million of loan. I'm not going to put that entire on my balance sheet. I will find a group of banks and we will share that risk together. So I will have 20% of this and I will syndicate out the other 80%. And you can see that there are lots of opportunities for underwriters, etc. in that as well. Lots of opportunities for smaller banks. And it also means that some banks can get involved in project financing without needing to go through all those technical protocols, etc. Because what they do is they look at the big bank which has done all this and say, if it was good enough for you, it's good enough for me. I'm a small bank. I'll take 2% of this. I'll just simply buy in, because I'm buying in on exactly the same set of terms and conditions as you, lead bank, negotiated with the project. And it's important that the syndicate works on the same terms, because otherwise some of the syndicate can be in breach without other parts of the syndicate being in breach. Doesn't necessarily mean that the valuation has to be identical, but it means that the other terms and conditions do have to be identical. So please remember, when we talk about the bank, we might mean lots of banks in a syndicate rather than a single bank. Banking syndicates can be good fun in themselves, because they need to be held together by a syndicate agreement. That's probably enough on that. I'm going to move to, somebody said there was a question, and then Victoria has disappeared, so.
Okay, great, thank you. So I'll take Dennis's question. So Dennis asks, what options are available for financing emergency power plants?
Because of the way the system works, I'll repeat the question. The question from Dennis is, what are the options for financing emergency power plants? Can we take just 2 seconds to note what an emergency power plant is? Yes. Emergency power plant is usually one which you need now. You don't want to build it for the next 3 years. You want it right now to make a difference. There are other ways of looking for definitions of emergency power plants, but really that's what you want. You don't want to spend the next 2 years building the thing. You want it now, which basically means you're buying a battery, right? And a generator to it, or a short-term generator, similar. A thing you can pick off a truck or a boat or a barge and just, there it is. Emergency power tends to be expensive, partly because it's small scale, partly because you want it now, you're desperate. Let's have a negotiation between the party providing and the desperate person and see which way the price goes. Right? So financing emergency power can be really awkward, because the first thing you look at emergency power is you say, I don't want that to be a 10-year permanent thing. I don't want to turn my emergency power plant into a permanent power plant because it's expensive. Usually it also works off diesel or something along those lines. They're not always the most environmentally friendly things in the world. The trick in financing is to understand that you want to get it, and it's going to bridge the space between power demand now and when you build a big, nice, shiny power plant which is going to fix the power problems of the world. Right? So all the emergency power plant is trying to do is cover the space while 2-3 years, 5 years, 10 years, whatever it is, where you're building your big, nice, shiny plant. You've no idea how long that is. So how long's my financing for my emergency power plant? Can I go to my bank and get it project financed? In theory, yes, but the bank's going to turn around and say, right, now show me the 10 years of cash flow from this plant because you want to repay it over 10 years. Well, maybe I can shorten the repayment period down to 2 years, 3 years. There's a negotiation to be had there. It's always going to be awkward to project finance an emergency power plant. It doesn't fit the easy profile for project finance, which means you've got a range of really poor options open to you. You can do it on a balance sheet, which is always reasonably expensive. And usually the financing will end up as some form of government backing into this. So that in essence, it's the government who's going to wear some of the term risks and also the obsolescence risk. Because remember, if you suddenly open a whole bunch of new power plants in the country, you don't need the emergency power plants anymore. You want to shut them up and go away. You don't want to keep using the EPPs, which are expensive, when you've got this nice, shiny, new, cheap, allegedly cheap power plant in there. So it boils down to there are no good options for financing EPPs. There are no obvious options for financing EPPs beyond something which means that the government is prepared to underwrite the volume and the price risks. As soon as the government agrees to underwrite the volume and the price risks, you ought to be able to raise finance against that. But that's on balance sheet, and that might be fairly risky stuff. There basically aren't any seriously good, obvious structural options. Otherwise, people will be doing it already. Sorry, Dennis.
Great. So I'll go. Okay. Yeah. So I'll go right next to the next question. So Esther asks, would it be advisable to use Eurobonds to finance a project, especially in low-income countries?
Ooh, that's a really good question. The question here is, would it be advisable to use Eurobonds to finance a project, particularly in low-income countries? Be careful. Bond markets are pretty poor things for doing project financing to start with, because what happens in a bond market is the bondholder says, I've given you my money today, I want interest starting tomorrow. Because in a project finance, what the bank does is it says, here's the money, we'll capitalise interest until construction is finished. Right? Bond markets say, pay me some interest tomorrow, and you cannot issue more bonds to pay interest on the existing bonds because that's called a pyramid scheme. It's not fun. It's fraud. Okay? So bond markets are pretty useless things for initial financings. What they are very, very useful for is refinancing. Because what bond markets offer is 30-year money. So instead of going to the bank and paying off your loan over 10 years, which is an annual amount of X, you go to the bond market for 30-year money and your annual payment is a lot less than X. And that's your gain. You're getting money today, or saving today, and you've got a cost tomorrow, which with the time value of money on means that it's less, etc., 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 etc. Right? So the goal here is then to understand that your annual saving in the bond market means that it's okay to make more annual payments. And the question then boils down to, does the Eurobond market deliver that? And the answer will be number specific. So there isn't a yes or a no, but there is now a method to calculate whether the Eurobond market will deliver that. Right? And you can see that I can borrow money into the Eurobond market at so much less than my project financing rate. So my annual saving for the duration of what would have been my project financing, my first 10 years, is this much. My payment, because I've now got annual payments going out 20 years, whatever, my payments into the future are this much. And if the first is bigger than the second, you do it. And if it isn't, you don't. Right? So the answer, I'm afraid I can't give a yes or no, but the Eurobond will give you the methodology to actually calculate that. That's true of any bond market. Be careful of bond markets because remember, you can't sell bonds on street corners. You can only sell bonds to sophisticated investors, etc. And so therefore the kinds of projects which are available, and that's why Eurobond is also quite interesting, because they're actually quite good at accepting a fairly big variety of projects. Whereas, if you try and sell bonds to pension funds, whatever it is, in specialist markets, you're looking at a different bunch of buyers, right? So the Eurobond has quite a big bunch of buyers, but I'm fairly sure there are energy bond sellers out there who simply say, we've set up this fund because what we're interested in is financing renewable energy. Because what we're seeing is long-term returns. And as a bondholder, what I want is a small amount of money for a very long period of time. As a bank, what I want is in and out as fast as I possibly can do. And so what you're then to say is this project type attractive to that particular bond market? Eurobond's not a bad idea, but I'm sure there are others out there which are more specialised, which in turn then means they understand the risk, which in turn potentially means you can get a lower interest rate from them. Does that make sense? Yeah. Sorry, does that make sense? I'm actually asking a person who I can't see whether it makes sense. Oh. Next.
I'm sure it does. So I'll encourage the audience here to think of questions. Yes, Esther says it makes sense.
All right.
Since you mentioned it, I'll just take the opportunity to pick up on that. So project financing for renewable energy. So I could just say a quick one on that, especially in light of current energy transition trends.
I'm not actually sure the energy transition makes an awful lot of difference here, except in the sense that what's going to happen is that you're going to want to do more renewable projects. So maybe energy transition makes sense in that it's just going to drive the number of projects. Because face it, energy transition is a good thing. It's an inevitable thing, really, if you think about it. But what it means is suddenly you've got an awful lot of relatively small projects out there. Renewable projects have always had problems getting their own niche. Is a renewable project the same thing as a nuclear, as a big gas plant, etc., or is it actually the solution for off-grid, village grids, etc.? Is it both? Is it neither? Is it everything? The identity of what a renewable project really is quite good fun to debate. As far as project finance goes, renewables projects are quite challenging because typically the projects aren't actually all that big. And project financing, you can see that it's going to work better for bigger amounts of money because the same amount of analysis has to go in whether you're trying to borrow $20 million or whether you're trying to borrow $2 billion, right? So the actual amount of money in the project isn't really the issue. Whereas, if you are wanting $20 million to build a few wind turbines, going through all this hassle of appraisal, technical appraisals, risk profile appraisals is a bit of a pain. So maybe the bond funds, etc., and the venture funds offer a better opportunity for renewables. And so all you have to do as a government, assuming that there is access to bond funds out there eventually to refinance, all you have to do as a government is get them built in the first place. That's much more challenging than it sounds. I suspect that project finance is not the easy answer for all renewable projects, but I suspect that where renewable projects have large scale, then yes, it will be a significant part of the answer. The danger, of course, in all electricity projects is that you earn money in local currency, and your costs are in US dollars, Swiss francs, euros, pounds, whatever, and you have a currency risk, and that can be. Remember in the power world, the whole point of regulating power prices is to kick rent out. In the oil world, we have rent. You dig up at $25, you sell at $75. Any idiot can make money in the oil market because you've got $50 to play with and you've got $50 to tax. But if what you're doing is generating electricity to go through to the local population, sticking a tax on that, all that does is raise the electricity price. So, taxing electricity and building rent into electricity doesn't make any sense as far as getting power to the people as cheaply as possible is done. And yet, rent is the easy way to fall back and pay interest, etc. So there is a challenge in that, a very big challenge in that. But I don't think the renewable aspect of it makes an awful lot of difference. I think what really makes a difference is the scale and then what it's going to be used for, who the market is. Because if you're trying to finance village grids, you're in a very different world from if you're trying to finance on-grid in big systems.
Yes, so I'll take one question from our audience here. Yes.
My name is David. I'm a student at the UKML. The concern for renewables is scale. But also the concern would also be the certainty of cash flow because of the nature of renewables. Do you think it is possible to house several projects together and project finance them as one. So
Portfolios.
yes, have a portfolio of projects.
Okay. I'm not sure how much our listeners are going to be able to hear you, so without wishing to be too patronising, I'm going to synthesise the question before I answer it. The question here is, given that project finance, particularly wind, solar, is going to have intermittent cash flows, it's got intermittent productions, so it might have intermittent cash flows. Whether it does or not is a slightly different question. And the question is, can you group them together? Can you have a portfolio in order to pile a whole group of these things together and finance them together effectively? The short answer is, yeah, in theory that works. That's not a silly idea at all in theory. But what's much more likely is that what will happen is that a trading house will buy the power from lots and lots of projects, right? And effectively the portfolio is through the purchase. And so the purchaser then says to the the purchaser takes the portfolio risk and then sees to each of the sellers, I will guarantee to pay you a certain amount of money. Don't assume that just because wind power is intermittent, that the cash flow to that wind farm is automatically intermittent. Right? So the broad idea of sticking things together in a portfolio works, but just be careful of where the portfolio actually is. There's space for different kinds of portfolios here, especially where you've got a centralised purchase from a trading house, which is going to purchase centrally. Now, I recognise there will be electricity markets where that is easier to enforce than others. Places like the European single market, that's already happening. Whereas less sophisticated in the sense that in the European market, what really defines it is its huge scope of standard terms. So the goal in the European market is simply to walk in and say, I want some power, here's some money, I'll trade on all the other non-price terms and conditions as standard. And not many markets in the world get to that, which means that the players are taking different kinds of risks. And so portfolios in the European market make a lot more sense, just conceptually, because there's not that many barriers in the way. Whereas if you've got a much more complicated market, then you're going to end up with a more complicated solution. Portfolios is probably a really good way forward because it answers the scale problem. And instead of trying to finance independently finance 10 small wind farms, you lump them all together and finance them as a big lump. The question is, do you finance them as an ownership lump as 10 wind farms, or do you sell their power collectively and then send the money to each wind farm in a guaranteed way? It strikes me you could do either. Personally, I would tend to suspect that the wind farms all selling to a collective point, the trader, and then the trader guaranteeing to each wind farm a certain amount of money. That, I suspect, would be more attractive to the banks, because the individual bank can then see, okay, that's a small project, but it's now guaranteed to get this amount of income, even if it generates, intermittently. Right. That was talked around the answer without giving an answer at all. But since I'm an academic, that's what I'm supposed to do.
Yeah, thank you. So we have maybe 2 questions online, but I'll take one.
No, take the online one.
Oh, okay then. So Dennis asked a follow-up question on bonds, but he gave an example of Ghana. Maybe we'll just mention that. But the other question is, what do you think project sponsors should do to attract banks to finance a renewable project in a country with excess capacity and a slow power demand?
Good question. Are you mic'd up so that everybody heard that?
Am I?
Okay. Okay, I'll repeat the question just in case, at the risk of being patronising. The question here is, how do you finance renewable power? What were the conditions again?
How do you attract...
How do sponsors attract finance in a market where there's excess capacity?
And a slow power demand.
And a slow power demand. That's an excellent question. Bluntly, finance isn't the problem there. The problem there is to guarantee that your power gets purchased. Okay? So the way you do it is you make sure you're inside whatever support scheme there is for renewable power. Because remember, if you've got any form of climate obligation, the way it feeds through the power is through a system which says we will buy this amount of power and we will pay a premium for it. Right? The question then becomes, how do you get into this amount of power? Okay? Most of the time that's a bidding process. And so if you can get yourself in there, you're okay. And if you're outside there, the system is saying, we don't need you, go away, wait until we do need you. Right? So I suspect the question is, the answer to the question is less about the banks and more about the guarantee of actually being able to sell your power. And so, they simply tell the bank, I'm in this guaranteed space. My power will be purchased. Right? And remember, renewables obligations, remember they are driven by a purchase obligation. People too commonly look at renewables obligations and say, it's all about the price. It's all about the price for the given volume. Volume first, price second. Right? You said there was a follow-up from Dennis.
Well, yes.
Presumably pointing out something I said.
Well, yes. His follow-up was, what are the risks in servicing energy debt with bonds, using the Ghana Energy Sector Levy as an example?
Oh, that's a fantastic thing. This probably isn't the place to get into the Ghana Energy Centre Energy Levy, which is itself probably worth a webinar. It's just such a weird, brilliant, and odd and amazing idea. It's everything to everybody. The real trick in bond risks is to remember that the bond player will be exposed to the risks for longer. Right? The bank's ultimate mitigation is it gets in and out in 10 years, or 8 years, or whatever it is. Right? So the bank doesn't really care what the project is doing in year 20. Right? The bond player does care, because the bond player is still being paid after year 20. So the risk is you've got to keep doing it for longer. Now, power stations typically, they're not, unless it's an emergency power plant, you don't really expect it to be dead in 10 years. You expect it to last 30 years, etc. It will be interesting to see what happens for renewables there, because remember, you may have to replace the turbine gearbox. You may have to replace some of the blades. You've got to do maintenance on them. There aren't too many 30, 40-year-old wind farms of today's technology for us to know what happens to them. So if you're a bondholder and you're looking at financing a wind farm today, you're saying, well, show me what happens to these turbines after 40 years. Who knows? Because the oldest turbine of this particular generation might be 3 years old. Right, so that's the risk, the time. Other than that, the risks are very much the same. Can you earn the revenue? Can you keep the performance going? Can you keep the operatorship going, etc.? But remember, bonds and time is the real key. I'm hoping. Brilliant. I'm not sure whether everything that pops up behind me as a clang is a question, or whether it's someone saying, stop.
No, that was a comment from me. So maybe a quick one from Daniel.
Thank you, Stephen. I should say that I answered one of the questions in my final exams here on project finance. So I wish I had this session before I got into that example. But moving on from that. So how much of a threat is international project finance to local lenders in countries where banks are charging very, very high interest rates to projects?
Ooh. That's an interesting one. Again, for the benefit of those who aren't necessarily on the microphone, the question asks, how much of a threat is project finance, global project finance, I believe you said, to local banks who may be charging high interest rates? Very high interest rates. That's actually quite a good question. Well, partly local banks are unlikely to, in those scenarios, are unlikely to be able to afford to put in, the odd $100 million. So scale is the first protection. The other question is, are local banks worth saving? Because one of the things that the local bank might want to do is actually join the syndicate. Now, the syndicate won't want the local bank unless the local bank actually has observed international banking standards and has a proper balance sheet. Right? Because one of the problems with typical local banks, and this is outrageously generalized, but there are far too many countries in the world which have not reformed their banking sectors. And reformed banking sector means it actually has a sensible balance sheet and bad debt is under control. Far too many countries in the world, the banks are effectively propped up by the government. And they don't need to report bad debt because, face it, they know that they've got a safety net there. Whether this is good, bad, or indifferent doesn't really matter. But in the international banking world, all the banks are signed up to pretty stringent requirements. If you're not in that stringent requirement, they won't let you in the syndicate because you're a risk to them. But I suspect the real answer to the question is scale. If you think local banks having local banks and high interest rates for certain things is a good thing, than simply keep them out of the sector by sheer scale. The other is that maybe it's a good thing if local banks charging very high interest rates actually disappear, because maybe that will stimulate demand and development and project. I'm not sure I know the answer to that.
So, syndicates, yes, Joe.
Well, a follow-up question that just came to my mind is if we can tie this question Daniel has asked now to the issues of local content and the elements of financing.
Yeah.
So to what extent will that not act negatively with respect of local content?
Yeah, it's always a risk. The question here, again, for the apologies for being patronising if you can't actually hear John. The question here is related to how local content rules affect financing. Local content rules are basically they're driven by the oil industry, because what you're trying to do with the local content rule is capture the spend inside the country. Because remember, the oil might cost $25 to get out the ground, but a significant point of that, a proportion of that, is usually spent outside the country, right? And so the idea of local content is to bring that spend inside, right? You do it by developing capacity, by basically and forcing people to do it. And the way you force people to do it is to say you can do it even if it costs a little bit more. They'll simply stick it in as a qualifying cost, etc. So that side of local content is okay. The fund starts for financing when you put financing in. It's an obvious thing to do for technical things and for lots of support activities for the oil industry. It's a much less obvious thing to do for financing, mainly because you get hit straight into the world of the quality of the lender. Now, in a system where the banks, a local content with the banks which would be providing the local content banks, if you like, if they are subject to the international regulation, there's not going to be a problem here. It will work. The problem will come where the local banks aren't enough internationally recognizable local banks in order to be able to provide the funds. And if you are a borrower, dealing with an international borrower dealing with a local bank which is effectively dependent on the government for its solvency is a different proposition from dealing with an internationally stable bank. I'm not saying you won't do it. I'm just saying recognize that borrowing from an entity which is dependent on the state is a different beast from borrowing from an entity which is supposed to have enough stability to live for itself, right? And that will be the problem going forward, as to whether the sponsors are prepared to take the risks on the local banks. Okay? Now, in structural terms, there's no reason if the local banks, reform and meet international obligations and actually have the capacity to do this, great. The identity of the borrower in project financing, so the identity of the bank, isn't really important. What matters is that the structure is followed. So, what should it matter if it's a local bank which is the lead bank on project financing, or one of the biggest banks in the world? It shouldn't make any difference at all, provided they've actually got capacity to do it. Right? But I suspect that the nasty linkage out there, the proverbial elephant in the room, is that high local content requirements for financing will require governments to undertake banking reform. And banking reform can be painful for governments.
Can I ask my next question?
Okay, yes, just a quick one.
Okay, while you discussed about EPPs,
Mm-hmm.
and then my question is, what's the place of renewable energy sources in aiding EPPs? Is it possible in terms of cost?
Right, again, at risk of patronising, the question here is on EPPs, what's the relationship with renewable energy costs and etc.? The short answer is renewable energy and EPPs should not really be talked about in the same sentence, because remember, what you're trying to do with an EPP is hit now and get rid of it. You're not trying to say my EPP is actually just a quick variety of a quick and dirty consent for a long-term project. My EPP is this year and next year while I'm building something nice and shiny like a windmill. So hopefully they have nothing to do with each other. That's a bit blunt, but...
Okay, we may have to close in a few minutes, but I will take Dennis's last question, and he asks, how do you deal with the political economy in all the project finance process. And he gives an example of Ghana reducing electricity tariffs by 18%. So I'll just tie that into another point we had on our poster on addressing difficulties of getting the first energy project in a country.
Yeah. The first energy project, for the question again. The question here is, how do you deal with the political economy as a project financing bank? You know, for example, lowering, the government lowers energy prices as they have in Ghana. Was it, did you say 18% price falls? The idea is simple. You just try and take account of that in your modelling for revenue. And you ought to be able to do it because remember, governments are an awful lot of things. People accuse governments of being stupid. They're not. They might do stupid things, but governments are smart. They might do stupid things for government reasons. Governments, remember, have a short-term horizon. They want to get elected again. And so you would do things as government which you wouldn't do as a long-term independent agency or something. And that's okay. That's the way the world works. To deal with the political economy, you just simply take account of it in your modelling. And you try and make sure that you then build in enough space so that you can see, well, we know it's going to be 18% over, for example, for the next 5 years, but what happens after that? What indications are we getting? And you've got to build enough space into your models to take account of that. It really does get that nitty-gritty. It's quite a challenge because, remember, in 5 years' time, it might be the other party which is in with completely different views, etc. So modelling that is really good fun, but someone else can do the webinar on modelling. Okay.
Okay, and about getting first energy project.
The first energy project. Yeah, the first energy project is always a challenge, simply because banks are inherently conservative. You know, if you can show me a project that works, I'll do another one that works the same. Whereas, by definition, the first project in the country doesn't have another one that works. Now, project financing comes to your help a little bit here, because remember, the whole point of project financing is to make the country irrelevant. It's the project that matters, right? So that was a stupid phrase to use. What you have to do is get it to that where that is actually true. But of course, in electricity, this becomes really quite difficult because one of the things that really matters in your modelling is how the local market works. So if you are in any way exposed to the local market, you can't find another comparable example anywhere else. So what you have to do is sell the entire output on a power purchase agreement and make, model it according to other countries where you sell the entire output on a power purchase agreement. So if you can contract into everything, I mean everything, the sales, the guaranteed volume, the price formula going forward, the escalators going forward, then you have a much better chance of building the first project. You really have to accept that you're going to contract in. And you also have to accept that you contract in at a level which is paying the political risk premium for that project, for that country rather. And so it can look expensive. But what you're doing is you're buying a project which everyone else can copy, but you also have, as a sponsor and a bank in particular, you have to be certain that the government will not turn around and say, well, you got your political risk premium at the start, but you're not getting it forever. The government has to live up to its side of the bargain. So contract into everything is the short answer, and also get the government to a position where everybody trusts it.
Okay, so thank you very much.
Am I now at the end? Do you want to put your microphone back on?
Yes, it is.
All right, sorry.
So we have to give up the room, unfortunately. So thank you very much, Stephen. Thank you, everyone. And thank you to our online audience. We did have maybe one issue that we didn't talk about, and I think that would be on project financing LNG and gas.
Well, maybe do another webinar.
Yes, yeah, but exactly, that's what I was going to promise. I think we can commit to possibly doing another webinar on that.
We could do on a pure LNG, that would be fine.
Noted, yes. And actually, to everyone that's online, if there are any specific ideas that you think we should do another webinar on, yeah, you can always email Victoria and we'll do that. Great, so we are going to close now.
And thank you very much to anyone online and still listening after all this time.
Yes.
Thank you.
Thank you.
Right.